Welcome to Invested Insider, your trusted source for the latest financial news and insights. My name is Jason Reynolds, and today is the 17th of August of 2023. We're diving deep into the recent financial news, dissecting the dynamics of the market, and helping you make sense of the headlines. Whether you're on your way to work or just unwinding after a long day, let's break down what's been happening in the world of finance. Let's start with the U.S. retail sales report that jolted investors recently. In July, retail sales surged by 0.7%. On the surface, this may seem like good news, a sign of a robust U.S. economy. Indeed, this surge is reinforcing the belief that the U.S. can withstand a recession, especially after over a year of rate hikes by the Federal Reserve. However, there's a flip side. This data, though indicative of a buoyant economy, is a double-edged sword. Why? Because it also signals that the Federal Reserve might have more ammunition to support further rate hikes this year. And what's the ramification? We've seen the benchmark 10-year Treasury yield trading at one of its highest levels since 2008. But let's contextualize this for a moment. Rising yields can have a negative impact on U.S. stocks, though the exact threshold is debatable and depends on how quickly these rates ascend. In the past, higher yields have sometimes even been favorable for riskier assets. The market did rally for the first half of the year despite the 10-year rate's rise. Now here's the concern. If the 10-year yield crosses well above 4%, it could elevate the cost of capital for smaller businesses and consumers. In simpler terms, borrowing becomes expensive, which could destabilize the stock market's foundation. Quincy Crosby from LPL Financial aptly mentioned, "This is a situation when good news really is bad news." But amidst this, there's a broader debate happening. What will the economy look like post this phase of monetary tightening? How will we adjust once rates start normalizing? Keith Buchanan from Global Investments provided some perspective, hinting at a key question. Can inflation maintain its descent, especially with consumers in a strong position, and can monetary policies avoid harming the economy? And remember last week's concern? China's economy slowing down, and the worry that it might pull the U.S. economy with it? It seems investors have moved past that narrative. China's challenges, though significant, are now deemed as well documented. Now let's talk about a key driver for July's retail sales boost, the digital realm. Online purchases, especially on platforms like Amazon during their Prime Day, played a pivotal role. In fact, the report was significant enough for economist Daniel Silver of J.P. Morgan Chase to comment about an upside risk to their 2.5% real GDP growth forecast for the third quarter. But not all was rosy. Post the retail sales report, all three major U.S. stock indexes opened lower, and the Dow Industrial sank by over 250 points. Now, if we look at the broader picture, the Federal Reserve has delivered a series of rate hikes since March 2022. These hikes have raised its main interest rate target to a range between 5.25% and 5.5% from almost zero previously. Given the backdrop of a historically low unemployment rate and wage increments, the U.S. consumer continues to spend, and many believe that as long as this consumption pattern holds, a recession remains unlikely. Finally, on the global scene, while U.S. indicators are showing what some economists call unspectacular growth, China presents a contrasting image. China's central bank cut a range of key interest rates trying to reinvigorate its economy, painting a somber picture for the world's second-largest economy. Moreover, on Wall Street, despite the turbulent times, optimism prevails. With strong economic indicators, the earlier calls for a potential recession have been pushed back. Many strategists, noticing the resilience of the U.S. economy, are forecasting higher end-year targets for the S&P 500. This shift in outlook emphasizes the strength and adaptability of the U.S. economic engine. So, what's the takeaway? The financial landscape is intricate. While certain indicators spell optimism, others urge caution. As always, we're here to provide clarity in this dynamic world. Join us again for another episode, and until then, stay financially savvy.
The Invested Insider podcast does not offer any financial, economic, legal, accounting, or tax advice or recommendations. The information provided in this podcast or on the associated blog should not be construed as investing or financial advice and should not be considered professional advice. The views, opinions, and content presented in this podcast do not represent the endorsement or approval of Invested Insider, and assumes no responsibility for the accuracy or completeness of third-party materials or content referenced in the podcast.